Here's what's coming up on today's show.
Too much in real estate, I think, is risky. But if somebody has a couple different properties, that's okay. But it's like running a full-time business, which if you're retired, maybe that's something you don't want to be doing.
Hello, this is Mark Silverman, managing member and founder of Silverman & Associates, and I'm also a certified financial planner professional. I want to welcome you to the Saving with Silverman podcast. I'm glad you're here. Each week, we'll discuss different financial planning topics because making smarter choices about your money impacts the quality of your life.
Let's talk about real estate. That's a topic that we often explore on this show. Real estate and retirement planning. With interest rates being higher for the last year and a half or so, while home prices remain high, what are the opportunities and challenges that has all created for your clients?
Well, hopefully people still have, a lot of our clients don't have mortgages anymore. They paid those off. But our clients that do, I would say the majority of them have been able to, refinance during, our record low interest rate environment versus what it was, what it is currently. Yeah. Rates are supposed to come back down. There's a high likelihood of that, maybe actually 2 cuts this year, which will improve the market, real estate market, et cetera. So, we give advice. It's based on what we know today. And things do change, so the advice can change depending on that. That's why it's not just set it and forget it. You've got to have someone that's looking at your situation and can make changes as your situation changes, as the economy, as the markets change, et cetera.
You're certainly right about those older clients and folks who have been in the real estate market for a long time, but it's a really tough time for young people trying to get into it and buy their first home.
What you can afford with a mortgage that's 2 or 3% versus 6 or 7%, it's a difference. I mean, my first mortgage was 6%, and I thought that was a good rate, but when you have these younger people who all they've seen in their lifetime is 2 or 3, they think 6 is highway robbery, which historically it's not. If you have people who had mortgages in the late 70s and 80s, some of those people were paying 18 to 21% on a mortgage. So
it was ridiculous.
It's all perspective.
Yeah, that's for sure. Some people place more of an emphasis on acquiring real estate instead of funding retirement accounts. Have you seen people successfully use rental properties to create the retirement income that they need without having much saved in retirement accounts?
Occasionally. I would say for the most part, when people decide they want to do this, there's a lot of things they need to consider. I personally, my own experiences, I've had rental properties. I'm not a fan, personally. If you have a couple and you do it correctly, I think that's fine. If you have mortgages, it makes it a little more challenging for cash flow. But you have property taxes, insurance, the whole COVID thing where people couldn't kick people out of the house and they weren't getting paid, put a bad taste in a lot of people's mouths. Those people never got their money back or got paid for those months or actually years that people were in those houses, and a lot of them ended up getting trashed and they had to get them back, and a lot of them sold them at that point. So there's some risk involved because, you don't want to sell in a down market. When interest rates are high, it's tougher to sell those properties. And so, and also there's, if you hire a property management company, they're going to take 10%. So that takes into some of your cash flow from that. If you're doing it yourself, that makes it a little easier, but you get to a point in your life where maybe you don't want to be going and fixing a toilet or that sort of thing.
That's hard work.
It is. So you get to a point when you get older that maybe you can't do it anymore. Yeah. And so then you end up having to sell those properties, and it may or may not be ideal time to sell versus having liquid assets or, securities, that sort of thing that you can get in and out of, and there's no carrying cost and taxes and insurances that you need to provide, and making sure that your place is rented. Because if somebody does move out and you don't have a renter in there, you still have to, you still have your upkeep to keep it going. So too much in real estate, I think, is risky. But if somebody has a couple different properties, that's okay. But it's like running a full-time business, which if you're retired, maybe that's something you don't want to be doing.
Yeah, if you want to rely too heavily on real estate assets, those are some things to keep in mind, that's for sure. Now, Mark, if somebody came to you as a pre-retiree with relatively limited amounts of liquid assets, but a tremendous amount in real estate holdings, would you encourage that person to sell some of the real estate or work with what they already have?
We could work with what they have, but I do encourage it, and I'd show the benefits of having it diversified into a portfolio. Because I can show, historically speaking, equities have done better than real estate over time. Just, there could be a one-off where somebody bought a property that was distressed and they put a bunch of work and money into it and turned it around and made a profit. But that doesn't happen every time. And there's risk involved with that versus when you buy a good quality company and hold it for our time. I think it's a lot easier. So I could make the case, but if somebody really, really wants us to build a plan and they want to keep all their real estate, we'll work around it. Will I give them a conversation and show them there may be a better way? Absolutely. But at the end of the day, it's their decision on what they want to do.
Last question I want to ask you here about real estate and retirement planning is kind of controversial. For people who don't have rental properties, but they want to use their primary residence to create income with a reverse mortgage, would you consider that to be a viable option?
No. So for people that don't understand, reverse mortgages is where you actually get money out of the house. It's paying you. They're done through the government. They're about twice as expensive as a regular mortgage, so you're paying a lot of fees. You're not going to get 100% of your equity out of it. The government's not going to lose on it. I've used them a couple times with clients, and really where it comes into play is if somebody can't afford the mortgage payments anymore, they typically don't have any children, and they want to stay in their house, and they can't afford to stay in their house. It's really the only option that's out there. But just to do a reverse mortgage, to do it, makes no sense because the fees on them are tremendously higher than they are on a regular mortgage.
Yeah.
And so I don't see that as a good option. It's a last resort. Again, if somebody really needs to stay in their house and they don't have the funds to keep that up, and that's the only option that they have, and they're not worried about passing on the money from the house to the kids because typically that money's going to be gone. Once the house is sold, they'll have to pay back the mortgage, and if there's anything left, usually there's not. So I would tend to shy away from those unless it's a last resort, so I don't use those very often.
You've been listening to the Saving with Silverman podcast. If you have any questions at all about your financial situation, please give Mark Silverman a call. Again, his number is 520-333-7601, or go online to savingwithsilverman.com. For Mark Silverman, I'm Ron Stutz. We'll see you next time on the Saving with Silverman podcast.
The Saving with Silverman podcast is brought to you by Silverman & Associates Wealth Management, LLC, based in Tucson, Arizona. The show is available on Apple Podcasts, Spotify, Google Podcasts, and everywhere you listen to shows. Subscribe to the show on your favorite app today and never miss an episode. Just search for Saving with Silverman to find us, or visit savingwithsilverman.com to listen to past episodes, to contact Mark, and to learn more about how to make smarter decisions with your money.
Did you know that Mark Silverman also has a radio show? Tune in to Saving with Silverman Saturdays and Sundays at 3 p.m. on AM 790 KNST.
All matters discussed on this show are for informational purposes only. Opinions expressed are solely those of Silverman & Associates Wealth Management, LLC, and staff. All topics covered are believed to be from reliable sources. However, Silverman & Associates Wealth Management, LLC makes no representation as to its accuracy or completeness. This show shall in no way be construed as a solicitation to sell securities or investment advisory services to residents of any state other than Arizona or where otherwise permitted. Topics should be discussed with your individual advisor prior to implementation. Fee-based financial planning and investment advisory services offered through Silverman & Associates Wealth Management, LLC, a registered investment advisor in the state of Arizona. Insurance products and services are offered through Silverman & Associates, an affiliated company.